Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial condition.
Good morning. It's Tuesday, December 30th. I'm Phil Streible, Chief Market Strategist at Blue Line Futures. So the precious metals, they are snapping back after yesterday's sell-off. You got February gold hanging on to $4,400, up $58 on the session. March silver at $74.56, up $4.10. March copper up $13.60 at $5.70. You got platinum up about $70 at $2,200, and palladium futures just slightly higher here, and the gold silver ratio sits at about 59-1. So looking at the broad picture on the U.S. equity market, stocks, they are really searching for direction as traders await the latest Fed minutes here, clues on the outlook as far as interest rates, the dollar index, and also digest some of the news on the Ukraine-Russia peace efforts. So the S&P 500 unchanged, 69.53. The NASDAQ unchanged, 25,737. The Russell giving you an opportunity here, looking at that market yesterday at 25.41. because of the fact that we saw treasury yields continue to work their way lower, sitting at about 4.12%. Now looking at silver and gold, they are moving higher after slumping from their all-time highs in a volatile trading session, especially from Friday, Sunday, and then Monday, that big sell-off. It was one of the largest price reversals in silver's history, and it occurred during periods of very, very thin trading. So the silver volatility index did jump to 76. That jumped 30% here in one session. That was the highest since 2021. And if you were to sit next to me yesterday and you were to be hanging out on this phone here all day and talking to, probably I talked to at least 100 people yesterday, you're going to experience two very different scenarios. There were those that were using Friday's rally and Sunday night's rally to book some gains, to reduce some positions, and were patiently waiting for some kind of correction, indicating that prices had just gone too far, too fast, really overextending themselves, and they waited to add back near yesterday's lows. Then there was another group of people where they chased Friday, they chased Sunday's highs, and they were severely damaged because they averaged up too high, building too big of a position with no real risk management plan in the event of the type of sharp reversal. So that's where you have the margin calls come in, the forced liquidation. And if you know my motto, it's always been plan your trade, trade your plan. That's why I've got 5 dozen notebooks over here of all different trading ideas that I've developed over the last 25 years, different scenarios that have played out, different economic regimes, different levels of volatility, and how you want to attack those particular markets. When I go fishing, I take into account, am I going to go to the Gulf, the Bay, a river, a lake? Do I need fresh water? Do I need saltwater gear? Are they biting on the top, biting on the bottom? The point is, you got to have a plan, and when you screw up, you got to own up to it. If I go to a river and I only bring my pompano gear, well, there's no pompano there. So it's my fault that I did it. So you don't really want to blame others. You want to really own up to it. Don't blame the margins, the banks, the short sellers. Own up to it. You're the one who put the position on. I'm the one who put the wrong gear in the trunk of my car and I went to the wrong place. So that's why I really take a quantamental approach when it comes to this. And I recognize that when volatility rises, you've got to beta adjust your position sizing. That way you don't get squeezed out. You also want to take advantage of large moves in one direction to the other to trim positions and to add positions on. It's never an all or nothing type of scenario on here. That's why I like to add things incrementally. And if you work closely with myself, you'll notice that buy a little here, buy a little here, let a little go here, let a little go there. You're never going to catch the exact top and the bottom, and that's why I think adding and taking things off incrementally makes very good sense. Now, if you look at the gold market here, do yourself a favor. Pull up a daily chart of the gold market. Take out a little pencil and paper and draw from that August low, connected through the November low, connected through the early December low, and connected to yesterday's low. And what will you see? There's a trend line that it held in place. That, I believe, is one of the key trend lines to watch. Now, if the market could push back over that 44.50 level, 44.30-ish, was that previous all-time high. I believe that traders will come back in. They'll say that the coast is clear, and they will start to chase that market higher, potentially pushing it back up to an all-time high. That's just my opinion. Could be dead wrong here, but those are the types of things that I look at. I program many different algorithms. I've got numerous trading systems. I've done this for over 25 years in order to identify when trends are developing, when they're changing, watching volatility, taking that into account, taking in different risk factors that'll take place. Crude oil, for instance, been one of the worst performing commodities this year. You had the situation with Iran that had developed where prices had shot up to $80. Now we're starting to experience a little bit of geopolitical tensions coming back in with Russia, Venezuela, Iran, and that goes against that concern about the glut that's in the oil market. Now, crude oil does remain on course for a steep annual drop here. Worries about that global production will eclipse the demand here after OPEC and its allies ramped up the output to recapture market share. The point is that there's a fundamental factor there that is one thing, that's just one small thing, tip of the iceberg. Then you want to look at the quantamental approach of it and the technical approach and see that oil prices are starting to creep a bit higher. At what level would they break out to the upside and go from a bearish trend to a neutral trend to a bullish trend? And that's where you want to adjust your positionings in the way you go, because these markets, they go through bull and bear markets. Just look at all of them out there. They do it. There are periods of times where the markets, you're selling every rally, and there's periods of times where if you're working closely with me, we may even take short positions on some of these precious metals markets. I know if the economy goes completely kaput, the global economy goes completely kaput, what happens? Copper is usually the first one that starts to go. Silver is the one that plays catch up. Gold futures determine whether or not this is going to be a sustained breakdown and whether or not this will result in a reflationary environment where inflation comes back because of stimulation and things like that. So you want to look at these different economic regimes and take more of a systematic, non-emotional, technical approach while, of course, focusing on your position sizing, because that's the biggest mistake that I see people make is their position sizing. They ramp things up too aggressively and they average up too high. And when a correction comes, they're triggered by emotions rather than having that plan in place. That's why I always say, plan your trade, trade your plan. Now, looking at the economic data coming out, we're going to get that weekly employment data, and then we'll also get the Fed minutes here. Those are the things that I really watch. What are the inflation expectations? Are they rising? Are they declining? How is the dollar index playing out? How are yields playing out? What are the expectations for interest rates here? Are the rate cut expectations, are they increasing? Well, I could tell you in January, the likelihood of an interest rate cut's about 16%. But in March, President Trump was very critical about Jerome Powell again and who his predecessor is going to be. And if you look at the economic data coming out, we're seeing inflation continue to work its way lower. That's why we got to keep an eye on oil prices. Energy is one of the biggest factors when it comes into inflation. We'll also take into account the agricultural markets, the livestock, things like that. That's why it's beneficial to be a broad-based commodities trader and start to look at all these different markets, because you can get some clues and some insights on the economy. And when you keep track of all this economic data coming out, that's when you could really build out a plan and you could see things 3-4 steps out on how the economy will play out and which commodities are going to play the most important role. Now, if you look at the dollar index, that's unchanged at 97.74. The euro currency unchanged at 118.04. 10-year treasury yields, they got up near that resistance, 4.2%. They're dropping back down to 4.12%. Look at the volatility index, 1651. Looking at Bitcoin futures, 88,000 could potentially push back up over that 90,000 mark. And the S&P gamma exposure, well, it's neutral gamma right now. I always look at what happens in Europe, what happens in Asia, because European stocks, they were subdued here. As investors are waiting for the Fed minutes here, it's also most likely the end of their trading session, the end of the year. They're monitoring those Ukrainian peace efforts. And then you go over to Asia, well, those Asian equities, they snapped their 7-day winning streak, which came to an end here, and it ties in with the end of the year. So the MSCI Asia Pacific Index dropped about 0.2%. We saw some gains in Hong Kong, really failed failing to outweigh some of those losses elsewhere. It was the last trading day in several Asian markets, Japan, South Korea, and Thailand. You look at the ETF flows, because the ETF flows have really given me the gauge as far as where we're going with the precious metals. Are they taking this and they're adding on these dips, or are they reducing? And if they're reducing here, especially when you get steep sell-offs like this, chances are it's people finding themselves again and balancing their positions. So on the ETFs, they were buyers of the dip in gold, platinum, and palladium, and they were sellers in silver. If you look at the exchange traded funds, they added 72,000 ounces of gold in their holdings here with the fourth straight day of growth. So buying on those dips on the corrections here. In total, gold held by ETFs rose 19% this year to 99 million ounces, the highest level since September 15, 2022. You look at silver, they cut about 0.2%. The year to date, total ETFs rose 21% here, and they cut about 1.72 million ounces, and it was the fourth straight day of declines and the longest losing streak since November 10th. Remember last week, there was that one day where something came in and bought about 11.7 million ounces. I would not be surprised if whatever that was, the catalyst of those outflows yesterday, could be corresponded and tied into that, perhaps on potential profit taking in a very thin market, taking advantage of the end of the year, booking those gains here and looking for performance. Was it a hedge fund? Was it some other large sovereign fund out there? Who knows? People look for a narrative and a why and blame things like that. But the reality is, if you take the quantum mental, the non-emotional approach to this trading here, I think your life will be a little bit better here. So if you guys got any questions here, shoot an email, info@bluelinefutures.com. Got that gold futures pushing on up $70. Silver looking like it's going to push up about $5 here in the next few minutes. And continuing to rally off those lows as traders wake up and identify that some of the smoke, the coast looks a little bit clear here at the moment. But again, have a plan in place is all I can recommend to you. And if you need help developing one of those, shoot an email to info@bluelinefutures.com. Myself, one of my partners, we have Blue Line Capital. We've got Blue Creek Capital Management. We've got a Mining Alpha program. We also have a metals fund that has done very well this year here. So if you guys got any questions, again, shoot that email. And remember that futures and option trading does involve risk of loss. May not be suitable to all investors. Good luck, good trading.
Futures trading involves a substantial risk of loss and may not be suitable for all investors. Therefore, carefully consider whether such trading is suitable for you in light of your financial condition.